Joe Biden's decision to bow out of the race for president may just turn out to be a very consequential event for financial markets. Although this event was not entirely unexpected, I do not think that financial markets participants have really thought through all of the potential repercussions of this development. In this video, I'm going to evaluate whether and to what extent this development could have a major impact on bond markets and equity markets. Historically speaking, U.S. presidential campaigns and their outcomes haven't had a big impact on financial markets. That's due to the U.S. constitutional system, which gives relatively little power to the president regarding economic policy. In the United States, it's mainly the legislative branch, or Congress, which has the primary responsibility for formulating and implementing economic policy. However, this electoral campaign and its outcome may turn out to be more consequential than in prior electoral cycles. And this is for primarily two reasons. The first reason is that presidential power over economic policy has greatly increased over the past few years. The second reason is that the U.S. economy is sitting on the precipice of some potentially transformational changes. And the next president is facing some very, very tough and very important decisions. Therefore, the next president is going to have a bigger influence on the future of the U.S. economy than any U.S. president has had in several generations. Before getting into the epoch-changing decisions that the next president is going to make, I want to outline two main reasons why I think the upcoming electoral season could be very unsettling for financial markets. The first reason is that we simply don't know what the economic policies are of the Democratic nominee. Right now, it looks like the Democratic nominee is going to be Kamala Harris. But the fact of the matter is that nobody knows what Kamala Harris's economic policies are going to be, what she stands for economically. We don't know who her advisors are going to be. And this fact, in and of itself, could become very unsettling for financial markets. Financial markets know roughly what to expect from former President Trump's economic policies. The market also knew pretty well what Joe Biden's economic policies would have been if he had been elected. Financial markets participants have absolutely no idea of what Kamala Harris's policies would be if she's elected president. In my opinion, polls are very soon going to show that Kamala Harris has roughly a 50% chance of being the next president of the United States. And the fact that we don't know anything about what her economic policies are going to be is something that is going to be very unsettling for financial markets. The second broad reason why I think that markets are going to become unsettled is related to the first. And that is that prior to this moment, there was a lot of complacency in markets because we all thought that we knew sort of what to expect from what the candidates were bringing to the table, both Joe Biden and former President Trump. Right now, as I just mentioned, we don't actually know what Kamala Harris's economic policies are going to be. And I think that this is going to bring a much greater focus on economic policy than what we would otherwise have if it was just a contest between Joe Biden and President Trump or former President Trump. There's going to be a tremendous effort on the part of the media and on the part of financial markets to figure out exactly what it is that Kamala Harris stands for and to contrast that with the economic policies that Trump is bringing to the table. And I think that this whole process of trying to figure out and sort out what these economic policies are is actually going to spook markets at the end of the day, because I think that what markets are going to come to realize is that neither of these candidates and neither of these parties actually has any kind of even halfway reasonable approaches to the biggest problems that the United States is facing economically in the next few years. I'm going to focus on two main issues that I think that could spook markets. The first is the fact that the United States is on the precipice of a major fiscal crisis, both a fiscal deficit crisis and a fiscal debt crisis. Right now, the fiscal deficit in the United States is the highest that it has ever been when the economy is at full employment and during peacetime. The deficit is completely out of control. And there are no signs that either party or either candidate is even paying attention to this issue. And I think that when financial markets come to realize that President Trump doesn't have a plan for this and hasn't made it a priority, and Joe Biden didn't have a plan for this, and there's absolutely no reason to think that Kamala Harris is going to make this a priority in her campaign, I think that markets are going to become very spooked when they realize that the United States is fiscally heading over a cliff and the next president has absolutely no plan. Without a serious plan on how the U.S. is going to get its fiscal deficits under control, interest rates are going to rise. The U.S. is going to find it increasingly more difficult to finance these extraordinarily high fiscal deficits. And so this is going to become a real problem for the economy if the real interest rate rises and the interest rates on everything from mortgages to business loans continues to be high and could even get higher in the next few years. For the most part, financial markets, and especially equity markets, are pricing in a high probability that interest rates are going to be heading down in the next few years, and that interest rates are going to be heading down towards the very low levels that we've enjoyed in the last 20 or 25 years. That is not going to happen unless the United States is able to come up with a credible plan to bring down its extraordinarily high fiscal deficits. And as the market comes to the realization that neither candidate has a plan to get the deficit under control, this means that the market is going to start to anticipate much higher interest rates than it is currently expecting. And that could very much spook financial markets. The second issue that I think that financial markets are going to get very spooked about is the fact that the process of deglobalization is becoming very real. And neither candidate in either party has any sort of a plan to really deal with the economic and financial consequences that this is going to bring. Now, we have to understand that part of the major bull market that we've had in the United States since the 1990s has been driven by this process of globalization. U.S. companies that are multinational companies have massively benefited in terms of their profitability from being able to outsource their production to foreign countries, to be able to use cheap foreign labor, to be able to source cheap inputs and parts from all over the world. This whole globalization process that has made U.S. multinational companies more profitable than they've ever been, that have caused profit margins of U.S. companies to be higher than they've ever been in their entire history, this process of globalization is coming to an end. It's reversing. This is going to be inevitable regardless of who the president is. And the reality is that financial markets haven't caught on to this. They're still projecting earnings for U.S. multinational companies as if they're going to continue to grow at even faster rates than they have in the last 20 years, when the profitability of these multinational companies was precisely boosted by globalization. As globalization actually takes a turn in another direction, the profitability of all of these companies is most likely to fall. Now, as I pointed out, regardless who the next president is, there's going to be this process of deglobalization ongoing. But the real question is, who's going to manage this? Who has an answer for the various problems that this is likely going to generate for the U.S. economy? On the one hand, President Trump is to some extent aware of this issue of globalization, but he is fully moving in the direction of exacerbating this deglobalization. And he just picked a vice president that is very much in the camp of accelerating this process of deglobalization. Now, you can think whatever you want about deglobalization. A lot of people are for this. They think that this is ultimately good for the United States. But I'll tell you who it's not good for. U.S. multinational companies. And U.S. multinational companies have the highest weight in the S&P 500. Apple has almost all of its production facilities in China. Every single high technology company in the United States has most of its sales outside of the United States. A lot of its labor is actually sourced from outside the United States, programmers and so forth. U.S. production facilities at all U.S. manufacturers, major manufacturers, a lot of it is in Asia and particularly in China. This is not going to be an easy adjustment or an easy transition for U.S. companies. In fact, it's going to be very, very dangerous. Right now, financial markets seem to have no clue that one of the main sources of profitability and of profit growth during the last 30 years is essentially going to disappear. It's not that the world isn't going to be globalized, it's just that it's going to become less globalized. And as the world becomes less globalized, it's going to be an environment for doing business which is going to be less hospitable towards U.S. multinational companies, and it's simply going to be a less profitable environment. And financial markets have not come to terms with this new reality. One thing that I think is going to happen during this campaign is that as financial markets try to compare and contrast the policies of former President Trump and Kamala Harris with regards to deglobalization, what they're going to realize is that neither of them has a plan for the economic consequences of deglobalization. These consequences are going to be very profound for U.S. industry, for U.S. companies, for the economy, for our labor force. We don't have a plan for this new environment of deglobalization. And so I think financial markets are going to get spooked. Now, when I'm talking about deglobalization, I'm talking about various things. I'm talking about higher tariff barriers. Donald Trump is talking about increasing tariff barriers by 50% and even more in some cases. I'm talking about non-tariff barriers. I'm talking about rewriting of trade agreements. All of these things are going to cause higher costs for U.S. industries. That's ultimately going to translate into higher inflation for U.S. consumers. It's going to translate into lower profitability for U.S. companies. And all of this is going to generate problems in terms of employment, dislocations of employment and of capital from one industry to another. The U.S. needs a plan, but doesn't have a plan for dealing with these dislocations that are going to be caused by deglobalization. Another aspect of deglobalization is simply military. We have a situation right now where China apparently has a plan for either invading Taiwan or blockading it. This is extremely dangerous for the U.S. economy. The majority of the computer chips that go into almost all of our products come out of Taiwan. And so if the U.S. were faced with a situation where it had a shortage of computer chips, we don't have a plan for that. Neither candidate has a plan for that. So, in sum, as financial markets focus on the contrast in the policies of former President Donald Trump and Kamala Harris, they're going to be thinking about how the U.S. is going to be dealing with some of the most important issues that face the U.S. economy in the next few decades. And unfortunately, I think the conclusion that financial markets are going to come to is that the country doesn't have a plan. Neither candidate has even the slightest bit of credibility in terms of implementing a plan on the two issues that I focused on this video. The first issue being the fact that the United States is on the precipice of a massive fiscal debt and deficit crisis. The second issue being the fact that the United States is facing a major process of deglobalization. And this is going to be having a massive impact on the business environment that major U.S. multinational companies are going to be operating in. It's going to greatly affect their profitability, it's going to affect their growth, and it's going to affect the entire way that the U.S. economy operates. So what might be the impact of all of this on financial markets? Let's start with the bond markets. The fact that the United States doesn't have any sort of a plan for dealing with its fiscal deficit or its potential fiscal debt crisis is something that could really start to roil bond market. We could see bond prices fall, bond yields rise, and interest rates rise. Now let's consider the equity market. The fact that long-term interest rates may be higher than what were previously anticipated would cause the expected PE ratio on stocks to fall significantly. So the very fact that interest rates could rise, or that there's a higher probability that we could see higher interest rates going forward, could actually cause a correction in the equity market, adjusting to lower levels of valuation brought about due to higher interest rates. The other thing that could happen to the equity market is that it may actually catch on to the fact that the profitability and profit growth of U.S. multinational companies simply is probably not going to be as stellar as it has been in the last 25 years. In a world that is deglobalizing, the main beneficiaries of globalization will suffer from the process of deglobalization. And that could actually start to seriously bring down the valuations of U.S. equities, particularly in certain sectors that are extremely high. In fact, the sectors where valuations are the highest are actually the sectors that have most benefited from globalization. So a process of deglobalization could actually bring down PE ratios and valuations for those types of companies. Now, I want to circle back around to the question of how and why it is that some of these concerns that I'm mentioning could actually create some turbulence in the market. And for this, I really want to encourage all of you to watch my last video, because in the last video I discussed the fact that U.S. market structure right now is extremely vulnerable to a flash crash. It wouldn't take that much to get a flash crash going, or at the very least a pretty significant correction. If some of the concerns that I've mentioned in this video really start to build and to spook people, that could actually trigger a flash crash during the course of the electoral campaign. Normally, concerns about these issues might cause a repricing of equities of 2, 3, 4, or 5% at most. But at this particular point in time, because of the structural market vulnerabilities that we have right now, and which I described in great detail in the last video, the consequences of the things that are going to be happening during the course of this electoral season could be a lot greater than in any other electoral cycle. So thanks for watching this video, and I really want to encourage you to hit that subscribe button. Hit that subscribe button, because in the next few weeks, I'm going to have some extremely interesting videos about what is going to be going on in the U.S. economy and what you can expect in the performance of U.S. stocks and U.S. bonds going forward in the next few months. I'm also going to have some very interesting videos on topics that you're not going to see covered anywhere else. For example, in the next few weeks, I'm going to be putting out a video on the most important effect of monetary inflation on the U.S. economy. It's something that's called cantillon effects. It's something that hardly anybody understands, and I'm going to be making a video on it so that you can understand it. In another interesting video that we're going to be putting out in the next few weeks, we're going to be taking a look at Benjamin Graham's claim that the U.S. stock market is like a voting machine. We're going to be showing that this metaphor as a means of understanding price formation in the U.S. market is actually highly misleading. But in the process, we're going to be taking a look at some really interesting paradoxes that you've probably never thought of before. So I encourage you to hit that subscribe button, and I really look forward to seeing you next time.